substantive testing. If you remember substantive, it comes from the word substantial. And if you remember, we said we have what we call substantive audit procedures. Which ones are these? There are R, A, E, O, U. R, A, E, O, U. R is the analytical procedures where you analyze financial statements, compute ratios, do comparisons. You're comparing between this year, last year, what we call YOY, year on year. You're comparing the results of our company with the maybe very best in the industry. Yeah, through a process we call benchmarking. You are analyzing numbers. And then A stands for inquiries and third-party confirmations. As an auditor, to be able to dig evidence and get proper evidence, you need to do a lot of discussions, a lot of inquiries, internally and externally. All right. Then we have I for inspection. We must inspect documents. We must inspect physical assets. Observation, ladies and gentlemen, again, we have to see people in action. For example, if you tell me that there is this control where we are putting a soldier at the gate, when these students come at the school, first of all, this soldier has to look at their receipts before he allows them to get into class. You know, that's a control. But you see, as an auditor, I have a responsibility to appraise those controls. And then at the end of the day, I should be able to give a recommendation. So then as an auditor, I'll be required to do a lot of observation. So observe people in action, observe processes in action. For example, when you tell me that you normally count your stocks, then I would be interested in, right, seeing whether the stock count has been done very well. So I'll be observing. And then we have U. U stands for recalculation. U stands for recalculation and reperformance. Recalculation and reperformance. Because there is a U somewhere, recalculation. So as an auditor, I have to recalculate a lot. Now, from there, we went ahead and discussed something to do with the assertions. To assert is to claim authoritatively. When managers or directors give us financial statements, they make so many claims. And these claims that they make, they're divided into two. We have claims over statement of financial position items, and then we have claims over P&L items. So claims over statement of financial items, statement of financial position items, those claims, those assertions, we normally use the acronym of EVCRP. EVCRP. So whenever they have, for example, assets on the books, on the sheet. So they are telling us, in this case, that those assets E, they exist. But you see, that's an management claim. As an auditor, I have to test that claim. Do they exist? So I put in procedures to check whether those assets like motor vehicles, whether they exist on the floor, on the ground. So I'll be able to do a lot of observation. I'll be able to do a lot of inspection of documents. All right. So remember, it is EVCRP. That's how you remember this. So E is existence. C, ladies and gentlemen, or rather, we said with V. V is valuation. So they are telling us is that this motor vehicle you are seeing in our balance sheet has been correctly valued. It's a claim coming from the directors. Remember, professional skepticism allows me always to have a questioning mind, have a doubtful mind. So then what I'll need to do is to tell them, hey, you're valued properly. Which approach are you using? Cost model. So if it's cost model, I know cost model, you'll take cost minus accumulated depreciation. So under cost model, they will be using what we call net book value approach. So then what I'll do, I will ask for their depreciation schedules. I recompute myself the depreciation. Because in the schedules, I'll be able to know the assets they have. I will be able to know the useful lives. I'll be able to calculate myself. So remember, someone had done the calculation. So given that I'm doing it for the second time, then I'm doing what we call recalculation as a procedure. If they are using a valuer, then automatically, ladies and gentlemen, I will be able to do what here? Automatically, I will be able to ask for the credentials of the valuer. Is this valuer competent? Is he qualified? That is really important to me. And most important, I would want to know whether the valuer is independent. Is he independent of the directors, or is he a brother to one of the directors? So welcome to my 30th lesson. I'm making serious progress. Remember, my lessons in total, audit and assurance lessons, both at the intermediate and advanced level, they're normally 44. So I try to balance the entire syllabus into 44 lectures. Is there somebody who has been lucky enough to be attending all of them? Is there somebody who has been attending all of them since I began? And I hope if that is the case, you are seeing that there is lots of value for being at RCM. Yeah. All right. So lecture number 30 is substantive testing over intangible assets. Yeah, over intangible assets. Intangible assets. These ones, ladies and gentlemen, we must be very, very good. Remember, intangible assets are those assets that you can't touch. It's an asset. It's able to create cash flows for you. It's able to improve your business performance very well, but you can't see it. A good example is what we call goodwill. 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 A good example is what we call goodwill. Goodwill. Or research and development costs. So you see, when, for example, you have your shop positioned at a very good location, customers are able to just walk in and buy. It means that you're enjoying some form of goodwill. So it means that goodwill, as per the definition of what an asset is, automatically will be classified as a non-current asset. Yeah, because an asset is any resource that you control. It belongs to you. All right, you are able to control. And then most importantly, it's a resource that is able to give you cash flows. It's able to give you, or rather put you at an advantage position over your competitors. So you see now that is a non-current asset. Now, ladies and gentlemen, when I go to a company as Aura and Co., a firm of certified public accountants, which is licensed to do audit in Kenya here, and then I realize this firm, like Safaricom, they have put in a figure called goodwill and a non-current assets. So goodwill is intangible. So the question is, how shall I be able to test this? So then, as an experienced auditor, I know goodwill being an asset, it belongs to the balance sheet. I will have to remember the EV-CRP. So like if it is C, is this goodwill amount complete? Complete. R is the rights. Do they really have the right to this goodwill? P is presentation. How have they presented this goodwill on the balance sheet? All right. So then as an auditor, I will have quite an easy time. So welcome to this 30th session. I'm at the tail end of this syllabus. So the objective of this lecture is to understand how to audit intangible assets, especially research and development, to identify assertion-driven audit procedures and common exam question patterns, to clarify differences between tangible, what I can touch, and the intangible assets in audit context. What are intangible assets? Type. Tangible, non-current assets. So when they are tangible, they have a physical form. These are the ones in this case that will go to what we call property, plant, and equipment. The land, buildings, equipment, property, plant, and equipment, because you can touch them, you can see them. Intangible, non-current assets, no physical substance, you can never see them. So for example, we say like RCM now, it's a big entity. We have built a big brand. I mean, that brand, you cannot be able to see it. It is just somewhere there, maybe in the air, I don't know. Yeah, like when you have a copyrighted stuff, that copyright will have some value, but that value is not something you can touch. Then we have what we call research. and development. Ladies and gentlemen, if you look at, for example, very, very many organizations are into research. Like right now, if you look at these big automobile companies, they are doing a research on AI. Yeah, how AI, artificial intelligence, is able now to even drive these vehicles. Look at, for example, if you have a good Mercedes-Benz. Yeah, if you have a good Mercedes-Benz today and you go to, like, for example, of course, they say that it can also move on the road, but I don't trust that. So if you go, for example, this Mercedes-Benz to Nairobi Hostel car park, you'll simply just put it on auto mode and step out of the car and tell it to go and get a proper parking site, and it parks itself there. Yeah, so these guys already, they are doing a lot of research and development. And out of this research and development they are doing, they will be able to get serious monies in future. Look at this friend called, a friend of ours online, called Elon. When Elon came and said, hey, these vehicles can operate 100% through electricity, people are not trusting, in this case, what he was doing. He went ahead and invested heavily on this research and development, R&D. So what is happening right now, like in China, when you're in China, I mean, if you don't have an electric vehicle, it's disastrous. They're pushing everybody to go into electric vehicles. So now Elon Musk is able to reap big. You see, now his R&D is an asset. Why? Because this asset is able to generate cash flows at an opportune time. His business is able to benefit out of research and development. Right? Remember the definition of an asset. Yeah, so he's able to eat out of that. But is there somebody who could see that asset earlier on? We only came to see this asset once he started developing prototypes. Once you start producing a prototype, then of course, automatically you are at now the development stage. Prototype, like a vehicle now, like an ordinary vehicle, a very, very normal vehicle here, which is able to self-propel itself using artificial intelligence. All right. Then you have hit a place where we call development. And even at that point, now you have consumers who are even willing to invest in this. Great. So that's the first objective of this session, to enable you see the difference between intangibles and tangibles. So IS 38 defines intangible assets as identifiable, non-monetary assets without physical substance held for use in the production or supply of goods or services for rental to others. You're going to be renting this for rental to others or for administrative purposes. Key audit focus, it is R&D we are going to focus on. But of course, if an examiner asks you about auditing of goodwill, which is among us this, yeah, you should be able to use the same knowledge, intangible assets. So under IS 38, what is research costs? Research costs, ladies and gentlemen, remember when you're doing research, for those of you who have done master's and perhaps you're on your PhD thesis, research, you haven't really figured out everything. You are still at the very preliminary stages. You are still conceptualizing everything. You may have written a concept paper, yeah, said, I want to do a research on this. You're doing your proposal there. You're getting outside there to collect data. You have not brought yet anything into fruition. So there is no way you'll still tell us that this research is going to help people do this and this, and that people now will be willing to invest. People will be willing to buy these particular items from me because of the research I'm doing today. No. All research costs, according to IS 38, they shall be expensed in the income statement because they haven't yet reached a level where they become an asset. An asset should be beneficial to you. All right? Development costs may be capitalized, but only if all the 6 IS 38 conditions are met. The 6. You can only capitalize, ladies and gentlemen, as I go to read the 6, what I know, and I've audited this. These big organizations always they have R&D, and you'll always get directors wanting all the research and development costs capitalized. Unfortunately, because most directors outside there, they would want to project a big image that now we have a big capital base. We have a big asset base. And among us, the assets that they will use for window dressing, right? Creative accounting is now this research and development. They'll tell you, last year we used 3 billion for research and development. So let's have a non-current asset called research and development. It'll then open for them IAS 38. Tell them, out of the 3 billion, I'm 100% sure that what will be taken to the balance sheet under non-current assets will be development. Yeah, the cost of developing a prototype. Now you are beyond research. You are trying to come up with a real vehicle. And already there are people who are willing even to buy the vehicles when you start now producing them. All right? All right? So the 6 conditions, ladies and gentlemen, for you to be able to capitalize development costs are: the client, your audit client must be able to demonstrate that there are future economic benefits which are going to come, because we are looking at the definition of an asset. This means that will generate revenue or cost savings in the future. Technical feasibility. Has a working prototype been tested? Yeah. Has a working prototype been tested? Yeah, technical feasibility. Then we have financial feasibility. Once in this case, you've been able to get this prototype done and it has been accepted in the market, do you have a financial muscle to really now come up with, for example, many vehicles at once? If you don't have, then the entire development cost will be expensed. It cannot find its way to the statement of financial position. It cannot find. Great. So financial viability, does the company have the resources to complete development? Yeah. Ability to complete now the asset. Can the company realistically complete development? Do you have, in this case here, do you have enough engineers? Do you have enough staff? Then we have here intention to complete and the use stroke sell. You know, you could be having all this, but you're still saying, hey, it's still early. I don't want to complete this entire thing. I want to adopt a wait and see. What are my competitors doing? So if you don't have that intention to complete the asset, then automatically there will not be any development cost to go to the balance sheet. Is there clear management intent or a plan for use stroke sell? Then, of course, lastly, ladies and gentlemen, you must be able to measure all your development costs reliably. You are kept all the receipts, all invoices. You must be able to measure the cost at a cost directly attributable and clearly tracked. In exams, focus especially on the top 3. You must always mention them: future benefit, technical feasibility, and the financial resources, as they are the most frequently tested. Then now we get into substantive audit procedures for R&D. Yeah, so remember, ladies and gentlemen, anytime you are asked about audit procedures, I told you, as an auditor, I always have an objective against which I put in my RAEOs, against which I put in what we call the audit procedures. Those are RAEOU. I is analytical procedures. We have A, inquiries, because I have to inquire a lot. We have I, inspections. O is observations. U is recalculation. Yeah, someone will discuss about that. Don't worry, we'll discuss about that. All right, ladies and gentlemen, then please listen and listen to me very well. There must always be an assertion that I'm testing. The assertion is the goal. I gave you an analogy where I told you it doesn't matter how good of a footballer you are. You can be dribbling as you do somersaults as you, but if you don't score a goal, at the end of the day, people can't remember you very nicely. Even if you are a lousy footballer, but you're able to hit this ball, for example, from the middle of the field, you hit it just once without even dribbling at all, and it gets its way past the goalkeeper, enters. then you are a great footballer. The objective is to score. So also as an auditor, if you're working without assertions, and this is why so many, over 50% of the students who try audit and assurance at intermediate level, at the advanced level, they fail because they have never known the exam technique. Never mention audit procedures without knowing which assertion am I testing. Which assertion am I testing? So when you say, for example, I'll be doing inquiries. Inquiries to test what? To test what? Yeah, and you can see, ladies and gentlemen, I'm almost finishing this. Yeah, almost finishing this in less than 5 minutes. We should be out of this. You can see I'm 94 out of 99 pages. So the first one, of course, there will be a lot of inspections. Yeah, I will ask for documentations as an auditor. Yeah, so I'll be doing review documentations, project plan, prototypes if there are any test reports, if there are engineers who came, for example, to do tests. I would want to see this. And why am I doing this as an auditor? To confirm that for sure the project exists and meets the technical feasibility criteria. So basically here, I'm looking at what we call what here? I'm looking at existence here. Yeah, inspect board minutes or budgets to confirm continued funding for development. So in this case here, straight away, I'm still testing, confirming existence, and the fact that you guys have the financial muscle. Yeah. Inquire from research and development management about commercial viability of the product or service. Do you think in this case you'll be able to sell this item outside there? To evaluate whether economic benefits are likely to do what to flow. Remember up here we said these three are very, very important: technical feasibility, financial feasibility, economic benefits. Very, very important. Assertion, accuracy. It's important for me here. Assertion, existence, and rights. Yeah, the next assertion here is accuracy and evaluation. Has this thing been valued accurately? The procedure: inspect timesheets, payroll records, and the invoices for research and development staff and consultants to be able to see how much time they've put in. Because remember, in the evaluation, I would expect labor cost. So I have to audit the labor cost to see whether everything is okay, to ensure that only directly attributable costs are included. Yeah, because in the evaluation, we expect these labor costs. Recalculate the total capitalized amount based on support documents. They are telling me that this research and development has cost us $1 million. Then they have given me a schedule of all those expenses. Go and cast them. CAST, we call that casting. You recalculate the total capitalized amount based on supporting documentations to verify mathematical accuracy and ensure proper measurement. Now, ladies and gentlemen, remember, these tangible assets, we depreciate tangible assets. PPE, we depreciate. But when this goodwill and any other intangible assets, whenever they lose value, we talk of amortization. Yeah. So if in this case it's an intangible asset, then as an auditor, I would want to see how has this amortization been done? All right. How has this been done? Yeah. So in this case here, we have review amortization policy and recalculate amortization expense on the capitalized research and development cost to verify appropriate amortization equivalent of depreciation for intangibles. Then assertion, we have here classification cutoff. Yeah, the classification cutoff, especially in this case here for research costs. You see, research costs will go to the income statement, right? So you must ensure that they have been cut off to the proper financial year. So verify that costs incurred before technical feasibility are expensed, not capitalized, to ensure proper classification between research and development stages. Check expense/capitalization dates align with the project stage milestones. Milestones. Those young ladies who are around here, we normally talk of baby milestones. So this baby has been born just the other month, and now the baby can coo, the baby can, in this case here, smile. Yeah, those are milestones. So the same case with this research and development, we normally have milestones, right? We normally have milestones. So that this expense was for this milestone for this year. It's very, very important, ladies and gentlemen, in this case here to do what here? To track that progress. So check expense, capitalization dates, align with project stage milestones to verify cutoff and the correct classification. So summary flow, auditing, research and development, intangible assets. So first of all, of course, you'll be able to look at opening balance. Agreed to prior year audited financial statements. You see, for example, when they tell me, ladies and gentlemen, that I'm the auditor, and now I'm specifically looking at the intangible asset for 2025. So you see, they will give you opening balance 2025. I must ensure that the opening balance was brought so nicely from the previous year. Closing balance of 2024 will be the opening balance of 2025. That I have to check because there is always conmanship that normally goes on opening balances. Yeah. Any additions? Validate using IAS 38 conditions plus cost documentations. Amortization, recalculate and compare to what is given in the general ledger. The closing balance will always be equal to opening balance, what you brought forward, plus any additions minus any amortizations. There is nothing like this being sold. Key audit assertions that I'll always remember whenever we talk of intangible assets, I'll always remember these key audit assertions. Existence. Was the project real and active during the year? If it wasn't active during the year, then there is conmanship going on. Normally, remember, I always keep on telling you, ladies and gentlemen, that normally, whenever we are auditing, auditing normally is a cat-mouse kind of a game. The auditors there, not auditors, but directors there, they may have eaten something, but they would want to hide whatever they have eaten. And then, of course, as an auditor who is independent of them, doing, in this case here, work sent by the shareholders, right? I would want to catch these people. So I would want, in this case here, to see exactly what they're doing, all right? So there will always be a lot of what I would call, quote unquote, fightings. But of course, nowadays, audit has become very, very different because also as we progress, most directors are getting the fact that life is not all about just stealing and stealing. Yeah, there are companies, ladies and gentlemen, where we go and we get very straightforward directors, yes. So then we are able to add value as auditors quite easily because you're not fighting here. All right, ladies and gentlemen, in this case here, another, so existence. So the ones you are fighting with mostly, they want to book in assets which are not real. So as an auditor, this is something that I would want to check. Then we have rights. Does the company own the project and its outcomes? Yeah. So remember now, for intangible assets, you can't really start asking for a title deed. You can't ask for a logbook. So here you simply look at documentation here really. Accuracy and evaluation, are the amounts correctly measured and only qualified costs capitalized? Completeness, have all eligible costs been included? Yeah, if they're not included, all of them, then this thing is incomplete. Presentation and disclosure, is the intangible asset properly classified and disclosed? Yeah, how is the classification like? And in the notes of the accounts, have they done like workings there? Do they have proper disclosure? Common mistakes in exams. Mistake, listing generic property, plant and equipment procedures. Yeah, for the tangible assets. You must always talk about intangibles. IAS 38. Tailor procedures to intangibles, especially research and development conditions. Ignoring IAS 38 criteria. Always refer to future benefit arising out of this technical and financial feasibility. Failing to explain, why am I doing this as an auditor? always give action plus purpose. E.g., recalculate to verify. Yeah, what will I do? That is the action, that is the act. What is the purpose? To verify the assertion. Final exam strategy, as I sign off, start with the assertions relevant to intangible assets. Use the IAS 38 conditions to drive your procedures. Show that you understand what the client is doing and what you need to verify. Focus on relevance, sufficiency, and reliability of evidence as per ISA 500. As per ISA 500. I can see that's repeated. I'll be able to remove that. So that marks the end of this session, ladies and gentlemen. I believe as you get out of this room, when you go out there and you get a question on IS 38 intangible assets, for sure, you shall have something to write. Otherwise, if you haven't yet joined the RCM College, please search for us. You can't get better out there. That's all I can assure you. Because we're not only giving you like the theory thing here, you know, like myself, I'm an auditor who has practiced auditing like my entire life. I normally keep on multitasking between running RCM and running Aura and Core as the managing partner. So what I'm telling you here is exactly what we use in practice. And that is why I normally advocate to all my students to do audit and assurance as the paper of choice. Because it's only audit and assurance as your chosen paper that will be able to help you understand business. Yeah, you'll be able to know a lot. Otherwise, ladies and gentlemen, I don't think I should be able to keep you here any longer. We need to end this session. Thank you so much. I hope you've